There is an ETF sitting in your dividend portfolio right now that is quietly handing you back your own money and calling it income. And if you are building toward the point where dividends actually replace your paycheck, that one fund could be the reason you never get there. So this video is about 5 specific ETFs that look great on paper, show up in almost every dividend portfolio I see in the comments, and have a real mechanical problem that makes them a bad fit for anyone trying to live off their dividends in America. Not bad in a vague, the fees are a little high kind of way. Bad in a, here's the exact math on what this is actually costing you kind of way. Now the conventional wisdom says just find the highest yield you can, park your money there, and let the income roll in. And I get why that sounds right. A higher number next to the percent sign feels like more progress, but yield is one of the most misleading numbers in this entire space. And by the end of this video, you will understand exactly why, with the math to back it up. What I want you to walk away with is simple. The name of each fund, the specific mechanism that makes it a problem, and the actual number so you can run this on your own position size and decide for yourself whether to hold it, exit it, or just never touch it in the first place. I am not here to tell you what to do. I am here to show you what is actually happening inside these funds so you can make that call yourself. Let's get into it. The second most important one on this list is AMLP, the Illyrian MLP ETF. This one trips up a lot of experienced investors because it looks totally normal from the outside. It holds pipeline companies, it pays a decent yield, and it has been around long enough to feel established. The problem is buried in how it is legally structured. Most ETFs elect what is called regulated investment company status, which means the fund itself pays no corporate tax. The gains and income flow through directly to you, and you handle the tax on your end. AMLP does not do that. AMLP is structured as a C corporation, which means it pays corporate income tax at the entity level before you ever see a dollar. And because the fund holds assets that are appreciating, it has to accrue a deferred tax liability every single day for the future tax bill on those unrealized gains. That accrual comes directly out of the fund's NAV. Here is a real dated example. On May 29, 2026, AMLP recorded a tax accrual adjustment of roughly $4.3 million, about 1.8 cents per share, directly into its NAV. That is the fund's own corporate tax bill moving the share price, completely independent of how the underlying pipelines performed that day. The pipelines could have had a great day and your NAV still dropped because of this internal tax charge. The math on this matters a lot. The federal corporate tax rate is currently 21%, and when you add state taxes, you're looking at roughly a quarter of any unrealized appreciation inside that fund being set aside for a tax bill before it ever becomes your NAV gain. A standard equity ETF has zero of that drag. None. So you are not just paying your own taxes when you eventually sell. You are also funding the fund's ongoing corporate tax bill while you hold it. If you are in a taxable account chasing pipeline income, there are MLP-focused funds structured differently that do not carry this corporate tax drag. Worth knowing before you add more. But that is just one layer of the problem, because the next fund on this list has a completely different issue, and it is one that almost nobody checks for. NVDY is the YieldMax NVDA Option Income Strategy ETF. And the yield on this thing is eye-watering. We are talking north of 90% annualized at times. When you see a number like that, the natural reaction is either, this is incredible, or something is wrong here. And if you know where to look, you can find out which one it is in about 60 seconds. Every fund that uses derivatives or pays distributions from sources other than investment income is legally required to file what is called a 19A1 notice. It tells you exactly where the distribution is coming from. And almost nobody checks these. They are right there on the fund issuer's website under tax information, and they get posted every time a distribution is declared. NVDY's most recent distribution, declared June 23, 2026, was 93.71% estimated return of capital and only 6.29% estimated income. So out of every dollar they paid out, less than 7 cents was actual income generated by the fund. The other 93 cents was your own principal being handed back to you. Here's what that looks like in real numbers. Say you have $50,000 in NVDY at a quoted 90+% annualized distribution rate. That implies roughly $45,000 a year in payouts. But at this week's actual composition, only about $2,700 of that is real income. The other $42,300 is your own $50,000 being returned to you in installments. The share price structurally erodes because the capital base generating the distributions is being consumed. You are not earning income. You are liquidating your position slowly in small pieces and calling it a dividend. Now, return of capital is not always a catastrophic thing. It is tax deferred, it reduces your cost basis, and in some structures it can be used strategically. But when you are trying to live off dividends, you need the income to be real and the principal to stay intact. A fund that is 93% return of capital is the opposite of that. And the reason most people never catch it is that nobody tells them the 19A1 notice exists. That is important. But if you do not also understand what is happening with the next fund on this list, you could be losing money to a tax problem that is completely invisible on your statement. The best fund on this list to understand is QYLD, the Global X NASDAQ 100 Covered Call ETF. This one is everywhere. It is in comment sections, Reddit threads, and probably more dividend portfolios in this audience than any other fund I could name. And it has a real structural problem that is not a matter of opinion. It is math. QYLD writes covered calls on 100% of its NASDAQ 100 exposure every single month, and it writes them at the money. That means it captures the maximum option premium available, which is what generates the high yield, but it also surrenders almost all of the upside in the underlying index. Every month, no matter what the NASDAQ does, QYLD is capped. And over time, in a market that trends upward, that creates a slow, steady erosion of the capital base. The average annual NAV decline for QYLD over its lifespan is 3.72%. Not a one-year number, an average. So on $100,000, you are losing roughly $3,720 per year in principal decay before you even ask whether the option premium collected is replacing that loss. And here's the thing. Over the trailing 5 years through March 2026, QYLD delivered roughly 7% annualized total return. The NASDAQ 100 compounded materially faster over the same window. That gap is the bull market cost of selling away your upside every single month. You collected the premium, you missed the growth, and the headline yield of 11 or 12% approaches or exceeds typical long-term equity returns, which raises a serious question about whether a real portion of that distribution is just coming from the shrinking principal itself. If you are 45 years old and you need your capital to still be working for you at 65, a fund that loses 3.72% of its base per year has a compounding problem that the high yield does not fix. Run that math on your own position size. Take whatever you have in QYLD, multiply it by 0.0372, and that is roughly what you are losing in NAV every year just to the structural decay. Then compare that to what you are actually receiving in distributions and ask whether the net is actually positive. Now here's one that catches people off guard because it sounds completely reasonable on the surface. REIT Heavy Dividend ETFs. Not one specific fund, but the entire category of ETFs that concentrate heavily in real estate investment trusts. And the issue here is not the yield, it is the tax treatment. And it hits hardest in taxable accounts right in the income range of most people watching this. REIT dividends almost never qualify for the preferential dividend tax rate. Regular qualified dividends from companies like Coca-Cola or Johnson & Johnson are taxed at 0%, 15%, or 20% depending on your income. REIT dividends skip that test entirely. They stack on top of your other income and get taxed at your full marginal rate, just like a second job. In 2024, by market cap weighted average, 78% of REIT dividends paid out as ordinary taxable income, only 9% qualified as long-term capital gains. So the vast majority of what you receive from a REIT ETF in a taxable account is being taxed at your highest rate. Here is the math for a married couple in the range this audience typically falls. If your household income is over $100,800 in 2026, you are in the 22% federal bracket. Say you have $50,000 in a REIT ETF at the current average yield of about 3.7%. That generates $1,850 a year. Apply the NAREIT breakdown and roughly $1,443 of that is ordinary income taxed at 22%, which is about $317 in federal tax just on that one position. If that same $1,850 had come from a qualified dividend ETF, and you were in the 15% bracket for qualified income, the tax bill drops to around $277. That is a real recurring gap that compounds every single year, and most rarity ETF holders in taxable accounts never realize they are paying it. REITs can absolutely have a place in a dividend portfolio, but they belong in a tax-advantaged account, not a taxable brokerage, and definitely not as the core of a strategy built around living off income. Which brings us to the last one, and this one is almost the reverse of what you would expect. International and global high dividend ETFs held inside a Roth IRA. And I want to be careful here because the fund itself is not the problem. The account placement is. But the combination of the two creates a permanent invisible drag that most people never see coming. When a foreign company pays a dividend, the foreign government withholds a portion of it before it ever reaches you, typically somewhere between 15% and 30% depending on the country. In a taxable brokerage account, you can claim that back as a foreign tax credit on your 1040. The withholding is recoverable. But inside a Roth IRA, you cannot claim the foreign tax credit. The IRS does not allow it, so that withholding is gone, permanently, every year. The average drag from foreign withholding on an international dividend ETF held in a Roth runs roughly 0.5% to 1% per year. On $50,000 at 0.75%, that is $375 a year in permanently forfeited yield, not deferred, not recoverable later, gone. Now, $375 a year sounds manageable, but compounded over 20 years of contributions and reinvestment, you are looking at a 5-figure gap versus holding that identical fund in a taxable account where the credit is fully recoverable. The Roth is supposed to be your most powerful account. Filling it with international dividend funds is one of the few ways to actually handicap it. The fix is straightforward. Hold your international dividend exposure in a taxable account where the foreign tax credit works. Use your Roth for US-based dividend growers where there is no withholding to recover in the first place. So let's bring this together. 5 funds, 5 different mechanisms, and none of them show up as a warning on your brokerage statement. AMLP has a corporate tax structure that takes roughly a quarter of unrealized appreciation off the table before it ever becomes your gain. NVDY's most recent distribution was 93.71% return of capital, meaning almost none of it was real income. QYLD loses an average of 3.72% of its NAV per year to structural decay from writing at the money calls every month. REIT-heavy ETFs and taxable accounts generate income that is taxed at your full marginal rate instead of the preferential qualified dividend rate, a gap that compounds quietly every year. And international dividend ETFs inside a Roth IRA permanently forfeit the foreign tax credit, costing you a 5-figure sum over a long holding period. What changed from the beginning of this video is that you now have the actual mechanism behind each one, not just a ticker to avoid. You can take any of these numbers, plug in your own position size, and run the math yourself. That is the whole point. If you want to build a portfolio that actually supports you in retirement, the next video you should watch is the one I made on which dividend ETFs I think are actually worth holding for income. I will link that right here. It is the other side of this conversation, and the two together give you a much clearer picture of where to put your money. And if you are sitting on any of these 5 funds right now, drop your position size in the comments. Not asking you to do anything with it. I just want to see the math people are actually working with, because that is what shapes the next video I make. The more specific you are, the more useful this channel gets for everyone here.